Just take a look at these two charts. Seriously. On the one hand, you have the Western paper price for silver on the COMEX, and it is absolutely collapsing. But then, look at the price for physical silver in Shanghai. It's just soaring to new highs. Now, these two lines are supposed to be tracking the same thing. They should be moving together, but they're not. They're telling two completely opposite stories. And this isn't just a blip on the radar. This is a fundamental break.
What you're seeing here is, well, it's pretty much unprecedented in modern finance. The price flashing on a screen in New York is just not the real price people are paying for the actual metal in places like Mumbai or Shanghai. So that leads us to the big question, right? Why is this happening now? What does it really mean for you and me when the paper promise of a critical asset completely detaches from physical reality? We're going to break that down, step by step.
You know, here at Bullion Signal, our entire mission is to help you find that one critical signal buried in all the noise of global finance. And honestly, what's happening in silver right now is a perfect example. We build these explainers to help our growing community of investors navigate all this complexity. So, if that sounds valuable to you, make sure you subscribe and stay ahead of the curve with us. Now, to really get what's going on, we need to understand the structure of this thing.
All right, let's get into it. We've broken this whole thing down into 6 parts to really make sense of the chaos. First, we'll look at those two conflicting prices. Then, we're going to pull back the curtain on the whole paper market illusion. After that, we'll follow the money and the metal as it gets vacuumed up by the East and figure out the strategic reason why, AI. Then we'll give you a clear protocol for this broken market. And finally, we'll wrap up with the one crucial signal you need to watch. So, let's start with the big picture. What we're really watching here is a massive historic wealth transfer. It's just cleverly disguised by all these confusing market signals. See, the West is mostly focused on price, a price that's managed and kept in a box using paper derivatives. But the East? The East is focused on volume. They are just relentlessly acquiring the actual physical metal, and that fundamental difference is what's ripping the global market in two right now. Let's put a name on this, shall we? We're calling it the Great Divergence. This is when the price of a paper claim, like a futures contract or an ETF share, just doesn't match the real-world cost to actually get your hands on the physical asset anymore. It creates two separate realities. You've got the financial simulation happening in the West, and you've got a physical scarcity market in the East. Getting this split is the absolute key to understanding everything else we're about to cover. So you're probably asking, how is this even possible? How can the paper price just crater while physical demand is obviously going through the roof? Well, the answer is in the very structure of the Western futures markets. See, prices there aren't always discovered by simple supply and demand. A lot of the time, they are, for lack of a better word, administered through rule changes and leverage. It's all designed to protect the big entrenched players. Let's look at how that works. They call this an administered flush, and you have to understand it's a feature, not a bug of this system. Here's how it plays out. The price gets close to a key level that threatens the big short sellers. Then, bam! The rules of the game change. Margin requirements, the money you need to hold your position, gets jacked up. This forces leveraged traders to sell, not because they want to, but because they have to. And that forced selling triggers a cascade that just crushes the paper price. And this is the critical takeaway for any investor. You have to know what you actually own. A paper ETF, that's just a receipt for a price. It's a claim inside this managed system, and it comes with the risk of being paid out in cash if they can't find the metal. But owning the physical metal, that takes you out of their system entirely. You hold a real asset, there's no counterparty risk, and your purchase actually drains the very supply the paper system depends on. Now, this artificially cheap paper price in the West does more than just control the market. It creates this giant opportunity for the East. Think of it like a powerful financial vacuum cleaner. The massive price gap between a paper ounce in London and a real physical ounce in Shanghai has kicked on an arbitrage engine that is just sucking physical silver out of Western vaults and the speed is picking up. This isn't speculation, folks. It's just pure, powerful economics at work. And hey, don't just take my word for it. You can see the effect right here. The amount of silver you can actually see in the big Western vaults, like in London and New York, has been in a steady, undeniable freefall for years. Every time the paper price gets slammed down, it's basically a subsidy for physical buyers. It makes it dirt cheap for them to buy physical bars in the West, ship them east, and sell them for a handsome, nearly risk-free profit.
And at the exact same time, China has been making some very deliberate, very strategic moves to speed this all up. It's like a pincer movement. They make it harder for strategic metals like silver to leave the country while making it way easier for it to come in. The result? A one-way door. As our source material so perfectly puts it, they've built a silver roach motel. The metal checks in, but it absolutely never checks out. This vacuum is also operating right at the source, at the mines themselves. See, when the paper price gets hammered, it puts a huge financial squeeze on mining companies. So Eastern firms swoop in with a lifeline, a big injection of cash. But there's always a catch, right? In exchange for that cash, they get exclusive rights to the mine's future production. They're literally capturing the silver supply before it even has a chance to hit the open market. So this brings us to the biggest question of all. Why? Why this relentless, systematic hoarding of physical silver? This is way bigger than just playing a price difference for a quick buck. The deep strategic motive, according to our sources, is tied directly to the single most important technological revolution of our lifetime, the race to dominate in artificial intelligence. This is where high finance meets grand strategy. Here's the unspoken truth about the AI boom. It runs on physical silver. It is the most conductive element on the planet, which makes it absolutely essential for the high-performance servers and power systems that are the backbone of AI data centers. A modern AI server rack needs way more silver than an old one. Point is, you simply cannot build the hardware for the AI revolution without a massive, steady supply of this one specific metal, period. And this is where a raw material transforms into a geopolitical weapon. The analysis suggests that by cornering the physical silver market, a nation can essentially put a speed limit on a rival's AI development. Think about it. If your competitor can't get the silver they need, or if the cost goes sky high, their ability to build out their AI infrastructure gets severely choked off. Silver suddenly becomes a strategic choke point on the road to technological supremacy. This leads to a really critical long-term question, and I'd love to hear what you think about this in the comments. If the entire hardware future of AI depends on this one metal, what does that mean for the world, economically and militarily, when the physical supply is controlled by one single strategic competitor? What does that future even look like when one side holds the key ingredient to the other's progress? Okay, so we've diagnosed the problem. The price on your screen is a half-truth, at best. It's like trying to navigate a hurricane with a broken compass. So that brings us to the solution. How do you actually operate in a market with two different realities? You can't use the old maps. You need a new protocol. A clear framework for making decisions when the signals you've been taught to trust are fundamentally broken. Rule number 1 of this protocol is simple. You have to align yourself with the smart money. You become the arbitrage. This means you start looking at those paper price dips not as a reason to panic, but as a discount, a subsidy to buy the real physical asset. Every time the paper market gets flushed, you're being handed an opportunity. By choosing physical metal over paper claims, you align with the real flow of wealth and you help drain the system. The second rule is a total mindset shift. You have to stop obsessing over that paper spot price flashing on your screen. The real number, the true signal now, is the premium, the amount you have to pay over that spot price to get metal in your hand. That premium is the market screaming at you. It's the real price fighting to break through the paper suppression. When the premium goes up while the spot price goes down, that is your signal of extreme physical tightness. And the final rule of the protocol, look east for your data. The true floor under the global price isn't being set by paper sellers in New York anymore. It's being set by the highest physical bidder in places like Shanghai and Mumbai. As long as the East is willing to pay more for the real thing than the West is asking for its paper promises, any drop in the paper market is just temporary noise.
So this brings up a really practical question, and I'd really like you to share your thoughts with everyone in the comments. How do you personally track this stuff? What tools or data sources do you use to see the real-world premium for physical assets where you live? How do you gauge that true cost to acquire versus the paper price everyone sees on TV? Sharing this kind of boots-on-the-ground info helps everybody navigate this a lot better.
All right, we're at our final section. Time to close the loop we opened at the very beginning. We've got a paper market signaling weakness, and we've got a physical market that's signaling desperate, overwhelming demand. These two opposing forces are on an unavoidable collision course. And understanding what happens when they finally collide, well, that's the final signal you need to take away from all this.
If you only take one single thing away from this entire explainer, please let it be this. Throughout all of financial history, whenever a system of paper promises smacks up against physical reality, the person holding the physical asset is the one who eventually sets the terms. Financial leverage can create some pretty powerful illusions for a while, but it can't print physical supply. When all the games are over, possession is the only thing that's real.
So the final signal is this: that vacuum is still running. The price divergence we've talked about is offering a historic window, but that window is closing a little bit more every single day as more metal leaves the system for good. Eventually, the paper market has to snap back to physical reality. It is a mathematical certainty. Now, this analysis is a framework for understanding that risk. It is not direct financial advice. Always do your own research. This is Bullion Signal. The protocol is active.